Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 20th of June. I'm Daniel Lam, your host for the podcast. Just over a week ago, we spoke about how the Chinese Central Bank has stopped purchasing gold in the month of May, marking the first month of no buying since China started purchasing again in November 2022. China has represented 45% of monthly global net additions on gold on average. It was the largest purchaser in 2023 and the second largest year to date this year. Of course, the easing of central banks' demand would diminish the floor for gold, but a Fed pivot should theoretically be positive for gold. On that front, the easing inflation trend in the US is supportive. The Fed reiterated its desire to cut rates at the FOMC meeting at the end of last week, should inflation continue its falling trend. Looking at the historical data though, the relationship between Fed rate cuts and gold prices appear to be a little bit more nuanced. For example, while gold rallied in the 3 months leading up to the start of the two most recent rate-cutting cycles in 2007 and 2019, it was at best unchanged ahead of the start of the prior 3 easing cycles. Moreover, prices were flattish in the 12 months following the first cuts of 1989 and 1995 cycles, before subsequently declining. But here's where the nuance comes in. A key differentiator between these episodes is that the level of interest rates was higher during the earlier easing cycles than the later ones. Elevated interest rates raised the opportunity cost of holding gold, making the metal relatively less attractive. So it is not good enough to generalize. You must look at the Fed rate cut in context with the level of interest rates. Now, the 10-year TIPS yield is currently near where it was at the start of the 2007 easing cycle. Back then, gold prices rallied in the 3 years following the first rate cut. So therefore, it is reasonable to expect some sort of support for gold from the looming shift in monetary policy stance. In particular, gold ETF holdings have maintained the inverse relationship with real rates over the past 26 months, even though the price of gold has decoupled from real rates. This means there is scope for lower real rates to stimulate increased demand for gold ETFs. Technically, gold has support around the 2,300 level, followed by 2,200. Investors should consider adding around those levels. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.